Have you ever looked at a financial statement and felt completely lost? If that's the case, stick around, because in the next few minutes I'm going to show you exactly how to break it down very quickly. And if you can quickly break down a financial statement, you'll get a quick sense of what the whole thing means, and you can look at the details more easily. Every company has got three main financial statements, and once you understand these, you can analyze any business like a pro. So let's have a look through each of these three, and let's have a look at how you would quickly break them down to get a sense of what each one of them is saying. So first of all, we have the income statement, which is also known as the profit or loss statement, or the statement of profit or loss. And that basically tells you, as the name suggests, profit or loss, that basically tells you whether a business has made money, has made a profit, or whether they have lost money, whether they've made a loss over a particular period. But that's not all there is to it. It doesn't just give you a single number for profit or loss. It's actually structured around the idea of revenue, which is basically how much money the business has brought in over the year. It's then structured around expenses, which is everything that the business spends. So that could be wages, that could be rent, that could be lease payments, that could be raw materials and more. And then combining both of those, the revenue and the expenses, you end up getting the profit or the loss. Basically, whatever's left from revenue after subtracting all of the expenses. Now, obviously, there's more details to the profit or loss statement than that, but that's the headlines. And if you can get your head around that, you will have a much easier time reading a statement of profit or loss for a company. Let's say a bakery makes £100,000 in sales, but they had to pay £60,000 for their ingredients, for their wages, for their rent, and for other costs. That basically leaves you with £40,000 of profit before tax. And that's the kind of thing that gets reported on the income statement, on the statement of profit or loss. But what does that mean in real terms in terms of how a business is doing? Now, this is where some people get confused, because just because a business is making a profit, it doesn't necessarily mean that the business has actually got cash. That's why we need the other two statements. So next up, statement number 2, we have got the balance sheet, otherwise known as the statement of financial position. Now this one's a bit different because it's not really about a period of time. It's more of a snapshot of a company's financial position at a particular time, and that's usually at the end of the reporting period, usually at the end of the financial year for that particular business. They would produce the statement of financial position, known as the balance sheet in more simple terms. Now, the balance sheet tells you three things. Obviously, there's a lot of lines and detail in there, but in broad terms, there are three things that the balance sheet will give you. The first of those is what a company owns, and that's known as the assets of a company. That can be things like cash, equipment, inventory, various property that they own, money that's owed to the business, and that's known as the assets. The second thing that a balance sheet, a statement of financial position will tell you is what the company owes, and that's known as liabilities. And that will be things like loans, unpaid bills, salaries that are due, taxes that are due, and so on. And that's the liabilities. Number 2, what the company actually owes. And then the third and final component on the balance sheet is what's left over for the owners of the business. And that's basically known as equity. This is basically when you take all of the stuff that the business owns, the assets, you take away everything that they owe, and you're left over with what is owed to the owners of the business, which is known as equity. It's basically the net worth of the company once they've paid off all of their bills. And that kind of really tells you what a company is worth. So remember, a balance sheet includes assets, what a company owns, liabilities, what a company owes, and equity, what's left over for the owners. Think of it a bit like owning a house. If your house is worth 300,000, that's an asset. But if you still owe 200,000 on the mortgage, that's a liability. And because you've got a house that's worth 300,000 and a liability that's worth 200,000, you have an equity, which is your true ownership of the house, of 100,000. Here's one thing to remember. You could have a company that makes a huge profit on a given year. They might have a great profit on the income statement, But actually, when you look at their statement of financial position, when you look at the balance sheet, they've got huge debts. But then profit and assets don't actually mean much if a business runs out of actual cash. And that is where the third statement comes in, and that is the cash flow statement, or the statement of cash flows. Now, this statement is all about one thing. Basically, where is the company's cash actually moved? And that statement is broken into three parts. It's broken into operating activities, so that will be cash from the company's core activities. So things like sales, payments to suppliers, salaries, so incomings and outgoings cash-wise that are related to the operations of the company. The second part of the cash flow statement is investing activities. That would be cash that's spent on buying or selling assets and equipment and investments and so on. And then number three, there would be financing activities. And that's basically loans that are taken out, debts that are repaid, or dividends that are paid to shareholders. And so the cash flow statement basically tells you where is the actual money in the business going? Where is it moving to? What's coming in? What's going out in terms of actual hard, cold cash? So let's go back to our bakery. Now, it might show that it's got £40,000 in profit on the income statement, but imagine that all of the customers have bought on credit, so they haven't yet paid for what they've bought. That might mean that the bakery actually has zero cash in the bank, even though it's got a profit of 40,000, and that could be a big problem for investors. So this statement helps investors and business owners to see if the company is actually generating real cash in order to survive. So here's a quick recap. One, we've got the income statement, which shows you whether a business has made a profit or a loss over a particular period. Two, we've got the balance sheet, which shows you what the company owns, what it owes, and what it is actually worth. And then three, we've got the statement of cash flows, which shows you where cash is moving in the business. Well, there we go. There's the basics of the three main financial statements you will need to look at. I hope you found that helpful in terms of breaking those down. And if you still have questions, maybe some questions about the details of those statements, do make sure you drop them in the comments. And if you have found this video helpful, make sure to like and subscribe for more accounting insights.